and thank you for joining us today. For those who don't know me, my name is Stuart Arnold. I'm Director of Financial Planning here at Cullen Wealth, and we're privileged today to have in attendance Hugh MacTruong at Legal & General Investment Management. Hugh has been with Legal & General for 12 years. He was instrumental in the implementation of the multi-index funds that form a core part of our client portfolio today. He remains a key member of the team at Legal & General, and he's able to talk to you about how those funds are positioned today, but also Legal & General's views of the economy and the global investment markets. So he's here today to update you on how Legal & General is seeing the current situation, to help us understand how the portfolios are being managed, and to answer some of the most common questions that you, our clients, are asking of us. As some of you know, we have been running webinars to help our clients understand the situation with global investment markets, the economy, and more recently, the cost of living crisis. It's vitally important to us that you, as our clients, feel really well informed about the current situation. And this time around, we're trialling a slightly different way of communicating this to you. I'm keen to ensure that we provide you with the information that you need in the right format. As you know, we send out our monthly market commentaries by email to everyone who's subscribed to our regular updates. It's our intention to continue to find the best ways of providing you with expert opinion to keep you well informed. In this regard, we're keen to hear from you as to how best we can do this. So please bring us feedback, good or bad, ideas and suggestions, then do feel free to bring them directly to me, or indeed speak to your usual Cullen Wealth consultant. Anyway, most importantly, let's get into today's session. Today is a chat, questions and answers session between Hugh and I. I think it's important to say before we start that Legal & General are very happy to provide the views from their investment experts and fund managers, but it's important to highlight that these are views at a point in time, may change particularly in the light of fast-moving conditions. Also, they are only intended to be general responses and should not be taken as advice for any course of action. If you do need advice, then please come to us at Cullen Wealth, to either myself directly or to your usual Cullen Wealth consultant, and we'd be happy to help out. So, Hugh, nice to see you. Thank you for joining us today.
Thank you for having me here, Stuart. Always a pleasure to speak to you, the rest of the team at Cullen Wealth, and as well as the opportunity to speak to your clients.
Great, thank you very much. Let's start up. And as far as I'm concerned, you know, if we go back some 14 years, Hugh, we had the global credit crisis. That was a huge defining moment in the last 14 or so years. Prior to that, we had bank base rate somewhere around 4.5%, inflation somewhere around 2.5%. So we're now seeing a situation where the extraordinarily low interest rates and inflation are moving and changing. It was never going to be pretty, was it?
No, that's a very good question, Stuart. And if we go back pre-credit crisis time, this is before 2007, 2008. And basically the response that governments and the central bank formulated to the credit crisis was, one, the lowering of interest rates, as you mentioned before, they were higher, 4.5, and then we were pretty much down. Some countries, or even Europe, went down to zero. All the countries went well below 1%. And also central banks also did something that was quite new at the time, which they termed quantitative easing. Hopefully many of your clients have heard of this term, but this is the buying by the central banks of bonds, of government bonds, basically. And this was also accompanied by a number of governments also with austerity at the time, i.e. restricted fiscal spending. And what the central banks were trying to do over that last decade, post-financial crisis, pre-COVID, was fighting against deflation. We were too worried that inflation actually was too low. So we dropped, or the central banks dropped interest rates. They did quantitative easing. And while we didn't necessarily see inflation in the normal metrics such as CPI, interestingly, if we do look carefully, inflation did turn up in the system, and that turned up actually in asset prices, in stock market valuations, in bond valuations, i.e. low yields, pushed up the value of bonds, and actually you can argue in housing price inflation. Housing prices went up significantly. So while we didn't see the traditional inflation, we did see these assets inflate actually quite a bit over the last decade. And if you are an asset owner, was actually a very good thing. So if you had a portfolio as equities, bonds, property, you actually did quite well. So now with the reverse of quantitative easing, QE, call it QT, quantitative tightening, and the increase of interest rates, well, all the things that benefited from the low interest rates and the quantitative easing you would expect naturally suffer. So this is why we've seen equity prices fall, valuations fall. We've seen interest rates or yields go back up on bonds. So as yields go up, those bond prices are falling. And potentially in some markets, we have already seen the property market start to turn. And we know that the forecast for the UK property market might not be, or certainly not going to be going up as quickly as it did if it doesn't start to turn around potentially in the next coming months. So you could say, is this a normalization? Well, actually, I think what you described pre-financial crisis of bank rates 4%, inflation 2% is not what we're seeing today. And let's be clear about that. Right now, we're seeing inflation at near 10%. So that's one, significantly higher. So I wouldn't call that normalization. Two, we're still seeing global supply chain issues. In China, for example, they still have a zero COVID policy, which is still affecting us globally as the world's factory. And as well as since then, our trading relationship with China has deteriorated, particularly between the US and China. Also, during the pandemic, the US in particular actually carried out a massive fiscal transfer to households. They sent significant checks in the mail to the US, to US citizens, and that actually boosted demand significantly, which has driven inflation in the US far harder. And let's not forget, potentially most tragically of all, is we've seen a return to a war on European soil, actually, and the Russian invasion in of itself, obviously a tragedy, is also having a knock-on impact on markets, particularly on the gas markets in Europe. And that has caused gas prices to spike. And our economists, we see actually that having an impact of up to 6% on European GDP, far higher than what it was in the 1970s in terms of a energy price shock. So if we were just undoing QE, maybe we could have done that more gradually and more gently. But if you're combining all of these factors from significantly high inflation all the way to a return of actually war on European soil, actually, the market volatility, if you put that all into context, actually, you would expect things actually not to be pretty, and they certainly haven't been pretty since the start of the year. So it's made it a lot tougher for markets.
Thanks very much, Hugh. So from that, then we are where we are today. We can see where we are. So talk to us a bit more about how Legal & General are seeing the current situation and, of course, the future from here.
Yeah, certainly. In terms of interest rates, the US has been the fastest to move to be increasing interest rates. But we see the UK has started and they're increasing interest rates, and the Europe is doing the same as well. So the EU and the UK are essentially playing catch up with the Fed. And the reason the US has been able to move more quickly on raising their interest rates first is because the US economy actually has been doing quite well, in part because of the significant stimulus of the COVID checks at the time, and the EU and the UK didn't stimulate their economies as much during the pandemic. So there's less there. The second aspect is the US is actually more insulated from the energy price shock because the US produces most of its energy domestically now, whereas the UK, Europe is an importer of energy, and therefore that effectively acts as a tax break on our economies because that is money leaving Europe, leaving the UK, whereas in the US, that's just money going to another energy company, which you could directly tax, for example. So the European and UK central banks, they're in a very difficult situation. They want to maintain credibility because the first thing they need to maintain credibility is low inflation. Because if you lose control of your inflation and this is maybe going back to economics 101, what happens is that it becomes far more difficult to generate long-term economic growth. Because if you do not know what prices are going to be, it's more difficult to plan as a business what you're going to do, because when you don't know what the prices are, and then how do I invest, the course of action. So the central banks find themselves in a difficult situation. They know if they raise interest rates today, that's not going to be good for the economy. That could and may cause a recession. But if they lose credibility on inflation, that would be worse for the economy over the long term. So they're in a bit of a damned if you do, damned if you don't. So the central banks, they're trying to tame inflation today by raising interest rates. The Bank of England, right now markets actually are expecting the Bank of England base rates to go up to 6%. I mean, that's quite high. We think that's probably further than the Bank of England will actually have to go. We think that they might stop at about 4.5%. And the reason for that, we don't think it'll go as far, is if you look at, for example, where mortgage rates have started to move more recently, that's really started to have an impact on some individual households. I know I have some friends who've started to look at remortgaging or on trackers, and they're looking and they're like, what, I have to pay an extra £500 a month now? I mean, nothing's changed, but now my mortgage payment, £500 per month. And that's going to impact certain households quite significantly. If you're on a long-term fixed, great, you're going to be fine. But unfortunately, it just takes a bit of pain to be concentrated in one area to impact that marginal buyer, for example. So we don't think the Bank of England will be able to raise to 6%. However, on the other side, the gas issues, for example, in Europe, while they're going to be acute this winter, that's not a long-term issue. We'll be able to get some new supplies from the US, from Qatar in time, which will rebalance the gas markets. And as we invest more into clean energy, renewable energy, that should hopefully also improve the European and UK energy independence in time. And finally, I do want to say some actions, that the government have taken recently, though there has been volatility around that, is the energy price guarantee. That actually has been quite beneficial for households. We expect that to significantly reduce the inflationary impacts. We might have seen inflation go up to 15% without that, and that should help to push out the recession risks that we face here. So there are some positives there, but of course, inflation, has been the challenge, and that's why we see rates going up in the near term.
Thanks, Hugh. So, we've decided as a nation to take on a lot more debt to try and resolve some of these problems. And in the recent mini budget, the Chancellor rather infamously increased that strategy. Talk to us a bit more about how Legal & General sees the mini budget and its impact, please, on the economy and people's investments and finances.
Yes, Stu, that's certainly been a hot question, and the mini budget has caused a lot of ink to be spilled over. And let's say, yes, there were certainly some surprises in that mini budget, though a lot of the announcements in there were actually pre-announced. And actually, the surprise announcements themselves, compared to the pre-announced ones, for example, the energy price guarantee, we knew that was coming, is actually very big. The surprises, for example, at the time, the cut of the 45% income tax bracket, as well as the SDLT relief, those are relatively small, actually. But the issue wasn't what was maybe more of the tone and kind of what it meant, because while all of these pledges and tax cuts, in a way, were put out there, usually what the Chancellor will do is they'll indicate for how long they will implement these measures and how these measures will be sustainable for the government's finances. And we believe that markets were quite concerned because the government failed to convey what fiscal rules it would follow. So we know that the government has been trying to explain that, and they've brought forward when they're going to explain what they're going to do. So that's now scheduled for October 31st. And hopefully they can explain exactly how they're going to manage, basically balance the books, because they've made a lot of spending promises, but not explained to how all of this is going to be paid for or sustainable for the long run. And we know, for example, the government since then has reversed itself on the 45% tax bracket being abolished. The other thing that also came out around the time of the mini budget, if you remember just the day before or so, was the Bank of England underwhelmed with its interest rate increase. It only increased interest rates by 0.5% when a lot of the market was expecting 75 basis points, or I should say 0.75% increase. And that maybe tarnished a bit the market's perception of the Bank of England's credibility in fighting inflation. So those two things combined create a lot of volatility, one in the gilt market and in the sterling exchange rate. So those were kind of the drivers that we saw and kind of destabilized the market a little bit. Of course, the Bank of England has since taken actions that have stabilized the gilt market, and that has significantly helped. In terms of the fiscal side of the mini budget, the energy price guarantee I mentioned before, very positive in terms of that pushes out recession risks, reduces inflation risks. But on the other side of it, other things that were in there, for even a personal story, if I may, Stuart, indulge you. I actually recently completed on my flat here in London about a month ago and paid very high stamp duty. But the Chancellor, as it was my first property, I would have saved £11,000 and missed that by 12 days. So a bit of a shame to have missed that. But if I had been able to take advantage or gotten a new mortgage, if I get the mortgage rates from today, I would be paying £1,000 more interest to the bank per month than I am currently. So that £11,000 of tax savings I would have gotten by waiting 12 days, I potentially would have lost or be worse off after 11 months. So that just gives you an idea of kind of what that measure might do to the wider context, in that it's potentially not going to accomplish a lot, because the interest rates and how the Bank of England's had to increase interest rates potentially, or will do after that, will actually just completely dampen that. And so the rising interest rates that we're seeing will probably impact those who are less well-off borrowers who have a higher propensity to consume. So that's overall negative. And the tax savings that are potentially have been announced would probably benefit those who pay more tax and therefore have a lower propensity to consume, and so might not help the economy as much. So on the whole, we haven't seen this yet as a positive. So we're still waiting as the government makes more announcements, but certainly has been a challenging time for the UK.
But we've taken on more debt as a country, haven't we? And presumably the higher the interest rate, then the more the country has to pay back for the cost of that debt.
Yes, that's a good observation from the government side. But actually, on the reverse side, this might be the one piece of good news for your investors, and particularly your low risk investors. Because if we have a higher rate of interest, that means you have a higher risk-free rate. So in terms of expected returns for bonds and equities, all of that is driven off of what we call the risk-free rate. And this is usually the gilt rate, or the Bank of England's base rate. So if you're starting with a higher risk-free rate, 2.5% now, getting to 4%, 5% maybe, whatever it may be in the future, you're actually starting from a higher base. So that will increase your expected return on those assets. A lot of assets, though, in addition to the risk-free rate, will also have what's known as a risk premium. So your total expected return from assets is a combination of your risk-free rate plus your risk premium. So a higher risk-free rate, as we're seeing now, is actually good for your investors, as they'll actually have a higher expected return. And potentially in the future, we may see probably the same or potentially higher risk premium. However, I should hasten to add, if we do see a higher risk premium, that doesn't come without its costs. Because if it's a risk premium, that means it's compensating you for more risk, i.e. we might see more volatility in the future. And I think it's key to remember that what the Bank of England is doing today by trying to fight inflation, yes, is hurting low-risk investors in particularly, but if we do not fight the inflation today and it gets embedded in the system, that would actually be far worse for low-risk investors over the long term, as they're the ones that are most likely to be eroded by inflation over the long term. So actually, what's going on now is, yes, short-term pain might not sound short-term when it's a year or two, but over the long term, over your longer time horizon, which of course you should discuss with your Cullen's consultant as what's appropriate for you, should actually put the economy in better stead for the long run.
Okay, thanks, Hugh. That it's complicated, but you've explained it very well there, really, that, you know, as interest rates rise, then you should start to expect a better ongoing return from those investments.
Yeah, but of course, hasten to add, it might not be a smooth ride, of course.
No. So yeah. So well, no. Thank you very much for that. That's very helpful. So These higher interest rates, then, how do you see that affecting the behaviour of stocks and shares generally? I mean, we've also got equities, which are shares in companies, right? So presumably, if companies are paying more interest for their debts, then their profitability is going to be hit.
Yes, I mean, it will impact certain companies. I mean, that's unfortunately when you have rising interest rates. Ultimately, what the central banks are trying to do is to stamp out inflation to make sure it doesn't get embedded in the system. But of course, what they're running the risk of is a recession. So, but when you get that recession, typically what you would expect, though, is now, well, unfortunately, a bit of rising unemployment. So therefore, there's less pressure on wage demand and less general demand in the economy. So some weaker companies who are more reliant on debt that have to pay higher rates of interest, yes, they, as in a recessionary environment, would not be good for those riskier parts of the market. However, for the higher quality parts of the market, yes, it might be volatile, but over time that should recover. So in that aspect, the lower risk portfolio over time should provide a smoother journey. Going up to a higher risk profile is just that. It is higher risk. It could pay off. It might not pay off. That's the inherent nature of risk. So you have these trade-offs. Though interestingly, though, what you do start seeing, for example, if we do start to go into a recession, though, and those inflationary pressures start coming off, then the central bank actually might start doing the opposite and start reducing interest rates again. And that's when actually, ironically, you might start be doing better is when we enter that recession as an asset owner, especially if you're in lower risk instruments. As those interest rates come down, that portfolio might actually start to look a bit better.
So you mentioned recession. I've seen some other things in recent publications from you that you seem to be expecting recessions in most major markets next year.
Yes, I mean, we do publish our economic outlooks, and it is certainly not looking good in the three major regions of the world, that being the US, the Europe and the UK, and China. So if we go through them one by one, the first or most exposed to recession right now we see is Europe and the UK, and that's primarily driven by the energy price shock that we are experiencing. The increase in energy costs to the EU economy, we expect that to be 6% of GDP. That is going to be a significant hit. Germany, though, has recently taken action to say that Germans can basically use as much gas as they want and the government will pay for it. In the UK, we've provided a fixed energy price for households. So that way we can insulate a bit of that price shock, but that is going to cost us money.
Yeah.
So, but that is still a risk we see here in the near term in Europe. And it's basically that is what's causing our inflation right now. So it's basically a tax on the economy that is slowing us down in general. The US actually, if we turn to that market, actually is not having an energy price shock because they produce their own energy. And it's more of a redistributional effect from households to energy companies, which if the government wanted to, it can just tax those domestic energy companies, where it's very difficult for us to tax Russia or to tax the Middle Eastern energy providers. So we basically lose that money. So the US is raising interest rates because they need to cool down the employment market, as wage demands have continued to go up quite a bit there. And the COVID stimulus was very strong. So that's the situation in the US. In China, it's yet again a different situation that has been, some might say, self-imposed. They managed COVID very well for the first couple of years and maintained growth at quite high rates. But this is the first year that China has said, well, we're not going to give you a growth target. And they might not hit their 5% growth for the first time since anyone can remember now. And that is because of zero COVID policies. They're also getting tighter on their tech firms, which again, we can be argued is a good or bad thing on the whole. But again, this is not good for example, if you're an owner of those Chinese tech firms. So there are issues there. We believe after the Congress potentially, so the Chinese are likely to or are going to reconfirm Xi Jinping for his unprecedented third term, but they might, for example, we suspect may remove COVID or reduce COVID restrictions there, and they may finally address also the debt in their or the housing market that they have right now in China. So there's significant debt in the Chinese housing market, which is a cause for concern there. So they hopefully will start sorting that out after next month. So the thing is, though, about those three markets is that while there's certainly recessionary risks in the three major economies around the world, the drivers in each one are different. So, and even when you do expect a recession, strangely, I mean, in these times, you actually only get that right in 2/3 of the time, let's say. So you think there's a recession, but that only happens 2/3 of the time. Same time, ironically, when you don't think there's going to be a recession, 5/6 of the time you're right, and then 1/6 of the time a recession hits you out of nowhere, just the way COVID does, for example, right? And then you find yourself in a recession even though you didn't expect one. So the point is that yes, we see risks in all of them, but the point is to be well diversified across those different markets, both in your bond portfolio and in your equity portfolio, because each one may play out as we expect it to or may not actually. And by being diversified, actually you won't be exposed to the risks on any single one.
Yeah, thanks, Hugh. I just want to talk a little bit about our lower risk investors. We've touched on it a little bit there. You know, those individuals have seen an abnormal year where returns have been way different to expectations. Can you just help us to understand what's happened there and how you see the future for people investing at low risk?
Yes, Stuart, that's certainly been a big question, a big concern, you know, that we also share, as we've seen those returns on those lower risk profiles. And it is a very important question to ask. Why is it that it seems that the lower risk profiles seem to have lost just as much as the higher risk profiles in this context? And that doesn't seem like that's what you would normally expect. And the reason for this is because of the unique nature in terms of kind of what's been happening out there in the marketplace. So the rising interest rates, because we're trying to fight inflation, will first and foremost start hitting fixed income assets, which form a large part of lower risk portfolios. And as interest rates rise, well, then you see a rise in yields, which means that you see a fall in the value of those bonds that you hold. Because for that bond to yield more, its value needs to go down so it can give you more later. So in a way, yes, you held it, yes, you lost, but now you expect to receive more from it in long. That goes back to our earlier question of higher expected returns, for example, as well, because the yields have fallen. But that doesn't mean you don't experience a short-term pain now, which of course we know is not necessarily a solace. So for example, if we take a look at 10-year treasuries, so those are US government bonds. They started the year at yielding 1.5%, and now they're yielding 3.5%. So yes, the investors who've owned them through that period, they've lost money. But if you now own them, you have a higher expected return. You get 3.5% over that time period. And again, the reason the reason central banks have had to raise interest rates, ultimately we believe would be for the benefit of low risk investors over the long term, because if inflation gets embedded into the system, then actually low risk assets are the ones that are most vulnerable to having their value eaten away by inflation. So yes, it's painful today, and certainly we sympathize. It's not what you want to see or experience on your portfolio. You want to see those types of losses, but we're trying to protect it from being worse over the long term. On the other hand, I think we need to put things back into context. Again, as we said, what's been happening in the world. We have inflation now at 10%. You go back 5 years, would anyone have believed you that we were at inflation at 10%, right? We were like struggling to get to the 2% target for inflation. China has risen, and now we're putting trade restrictions on China, and they have a zero COVID policy that shut them down. We've had the corresponding gas price shock because of the Russian invasion. Let's not forget, yes, we have actual war, sadly, returning to Europe. And if it's a 10% loss on our portfolios, which is the biggest issue, actually, you have to put things back into context of what's going on there in the global economy. And so kind of what's happened as well is, so now the question is actually, I think the 10% losses we've seen thereabouts, unfortunately large, but as I said, we now have higher expected returns for those lower asset classes. The question is actually rather, why is it that the higher risk portfolios haven't lost more? Because actually a lot of equity markets are down 20+%, right? And yet they've also only lost about 10% in this context. And while I know that's no solace for lower risk investors, it's important to explain that higher risk investors do take a different type of risk, and they do take more risks. And one of the additional risks that higher risk investors take is overseas or foreign currency risk. So what we've seen, or the dynamic that's played out, is that as sterling has fallen in value, notably versus the US dollar, that has offset a lot of the risk in the high risk portfolios, because the high risk portfolios have more overseas currency. So that sterling fall has actually benefited the high risk portfolios and offset the greater losses that they even would have experienced otherwise. So while I know it's not comforting to think that high risk investors would have lost more, but they didn't, but as a low risk investors, I still lost as much as I did. Just keep in mind that what the central banks and the authorities are trying to do is trying to protect those long-term returns and actually have hopefully increased expected returns from those from those low risk portfolios from what they were before.
Thanks, Hugh. So if I can kind of summarise what I think you've just told us there, is that, you know, the economy, not just the UK, but overseas economies, the major ones, are in the midst of a huge restructure, a huge change, interest rates going from almost nil right the way through, in some cases possibly up to 6%, you know, inflation raging, and really there's I think there's a lot of that already priced into markets, already valued into investments. You know, we suspect that there will be some further uncertainty ahead, some more volatility, perhaps a little bit more pain for investors. But is it fair to say that some of that could now be behind us, and that the future is looking a little brighter?
I mean, that's potential. I mean, we are potentially just about entering the recessions, but as I said earlier, sometimes ironically, that could be beneficial for certain asset classes, as they may tend to perform better as the outlook changes. And also in terms of the recessionary risks, things might actually turn out better in some of them. You know, as I said, 2/3 of the times when you think there's going to be a recession, one doesn't actually happen all the time. So again, nothing's ever guaranteed in investing, and that's why diversification is so important to spread out those risks.
Yeah, and of course, just to say that the type of investments that Legal & General manage, that we recommend, are a core part of our client portfolios for nearly a decade now, are those global multi-asset type funds that enable you and your team, Hugh, to take the assets to wherever they need to be, whichever currencies, whichever countries, whichever types of assets, whether it's shares or fixed income or properties or commodities, as you think are appropriate for the clients at the various risk levels.
Yes, that's right. I mean, one of the key pillars of our multi-index proposition is diversification. And it's about spreading those risks, not having all your eggs in your basket. It's pretty much the first thing that you learn when you get into investing. So I think it's good that we're happy that you're recommending this to your clients, as we think that's the most sensible approach in these uncertain times.
Thanks. I just want a couple more minutes, and then we'll let you go. Just wanted to get a bit of an overview from you as to how you are positioning the Legal & General funds at the moment, what you're doing with the portfolios, where you're seeing the right places to be. Could you just update us on how you're seeing that, please?
Yes, sure, Stuart. Yes, and I'd reiterate again. Diversification is one of the key pillars of multi-index investing. And when you're seeing these shocks, for example, particularly in the UK, being diversified to other countries is key. So, for example, if we take a look at the fixed income space, so the government bonds in particular, we don't hold just UK gilts. And we know that UK gilts have suffered a lot of volatility over the last month or so. And so by being diversified to US treasuries, by being diversified to European bonds, your German government bonds, we're able to change that risk trajectory and kind of dampen that thing, because US government bonds had their issue back in March, but now not so as volatile that the UK is experiencing. So in a way, the volatility happens in different places at different times. Another market that we particularly like right now is Australia, or Australian government bonds, to diversify even further. So to get to one of the different dynamics in that economy, because that economy is more linked to China and commodity exporting. It's on a different interest rate cycle and is seeing different risks than the energy price shock that the European government bonds will be impacted, or the wage inflation issue that's happening right now in the US, or the government announcements potentially that are impacting the UK gilt market at this time. So each market has its different dynamics. So diversifying even to countries such as Australia, at times we've been diversified to, for example, New Zealand, Korea. So these are all different markets that we can access to provide that diversification. In the equity space, for example, we also want to make sure we're diversified away from not just holding UK equities. We want to be diversified internationally. So, for example, on the European side of equities, yes, we still believe in diversifying to European equities, but since we expect the recession to arrive there sooner, we want to move towards more defensive sectors. So this is things such as telecoms and utilities in Europe, and holding a bit less of the cyclical sectors, which would be automobiles and travel and leisure, for example. So that's what we're doing in the equity space. Well, we actually have plenty more things, but one of the key things is currency. As I said, we want to be diversified in terms of overseas currency as to avoid the impacts of inflation on sterling. So the more overseas currency, notably US currency, the better it is, as we've seen this year. And finally, in terms of overall diversification, it's getting that exposure to alternatives. So in the multi-index range, I think very uniquely for a product of this type is that you're able to get exposure to infrastructure, thematic funds, REITs, physical property, commodities, and forestry stocks. These are all different asset classes that provide a different return profile. So sometimes they'll perform well, sometimes they won't perform as well. But the key point is that they happen at different times and they have different drivers and dynamics. So that's why we believe in diversifying across different asset classes, equities, bonds, alternative asset classes, and then within each one of them, even being further diversified, not dependent on the risks of any single one.
Thank you very much. That's been really helpful. That's the end of today's questions. I guess if you wish to call it that. I wish to convey our huge thanks to you. And just to say to our clients, thank you for listening in and watching. As I say, I am really keen to hear your thoughts, good and bad, about this, how you can best get information from us that you need to help your understanding of this. We realise that it's a concerning time, and it's important to us that we give you any information that you need to help you. So do please either come directly to me, or please do go to your usual Cullen Wealth consultant, and we will get you the information that we can to help. So thanks very much for now, and bye from Hugh and myself. Bye bye.